China and the US, diverging paths, policies, and prospects. As you can hear by the name, it's a very big, very broad topic. I could probably stand here for a couple of hours just to talk about this. Perhaps fortunately for you, I only have 20 minutes. So I will try to keep it brief and keep it easily digestible. And I will start by talking about the US economy. So if we go back to in the beginning of this year and we look at what the expectations were for the US economy, in the beginning of this year, they were quite low. Inflation was still very much too high in the US. Monetary policy was tightening, interest rates were going up. And it was expected that the US economy would slow down in this year because of all these factors. And already in the beginning of this year, there were clear recession signals already flashing red back then. But that has not happened, and in fact, GDP growth, both in the first quarter and in the second quarter of this year, were much stronger than expected in the US. And we see that this resilience in the US economy, it really stands out compared to most other Western economies. We've talked about Germany, for example. Barely nothing has changed in Germany since 2019. And we also see that because of this, the labor market has remained overall strong. Unemployment rate has remained at its lowest level in 50 years for over a year right now. We do still expect that the US economy will slow down as these higher interest rates work through the economy with a lag, and we do see that consumption will slow down, and perhaps that the US economy will enter into a recession, but it is expected to be a mild recession and quite short-lived. And during our forecast horizon, which expands to the 2025, we still expect that the US economy will do better than most European countries. So if we do the same exercise with China, go back to the beginning of the year and we check what the expectations on the Chinese economy was in the beginning of this year, they were on the opposite. They were quite high back then. Because in the beginning of this year, China it abolished its COVID-0 policy. And it was expected that because of this, because of the reopening of the economy would recover quite well from the pandemic. It was expected that people would go out and consume, and that household consumption would be the main driving factor behind this economic recovery. That has not been the case, rather the opposite has been the case. Chinese data has been a disappointment. It has been much weaker than expected this year so far, and especially household consumption. So you can wonder, why is that the case? Why has consumption been a disappointment in China despite this reopening up? And I think one explanation for this could be that the pandemic has left a scar on the Chinese economy. And this scar could take a long time to heal. So, you know, China had this zero COVID strategy that was much more draconian, and it was in place much longer compared to many other countries. It completely froze economic activity, and it for sure raised uncertainty about future income development, so people started saving. And we see that consumer confidence dropped to historically low levels, and months after reopening, it remained at those historically low levels. An effect of this scarring, perhaps, from the economy. And expectations about future income development is still very weak in China. Then, as you probably also know, we have these very large problems in the property sector in China. And that is also something that is hampering China's economy right now. Possibly also contributing to the scarring effect of the economy, also contributing to why consumption is not picking up in China. We also see that China's youth unemployment rate has increased to record high levels. 20% of China's youth population, that's ages between 16 and 24, 20% are unemployed in China. This is partly due to some mismatch problems on the Chinese labor market, but it's also partly an effect of this very weak economic outlook and businesses remaining wary of hiring young workers because of this uncertainty. But it's definitely a big issue in China, and something also that explains why growth is doing so poorly now. This is a graph from an article in Financial Times from 1 year ago, showing that the number of data points that the Chinese Statistical Bureau publishes has been decreasing by quite a lot for over 10 years right now. Now it has decreased by over 50% compared to 10 years ago. And, well, one would typically not hide data if data was good, right? So it's obviously pointing to that the economy is doing poorly. But the author of this article, he also argues that there have been some people that have not really trusted Chinese official numbers, Chinese official GDP data. And for that reason, they have constructed their own kind of indices using other variables such as car sales, electricity consumption, traffic, and kind of make these proxy indexes to compare with official Chinese data. And in most cases, these kind of proxy data has showed that the official GDP data has been overstating how well the economy is doing. And therefore, many of these more granular data series has now been discontinued, making it harder to actually compare with the official data. So this lack of transparency is quite a big issue because it makes it even more difficult to kind of know how good or bad the Chinese economy is doing. And I mentioned just now this youth unemployment rate has increased to record high levels. So what did China do back in August? Well, it stopped reporting data on youth unemployment rate. So now the problem has gone away. And this follows a trend with other articles from Financial Times, which alleges that China moves censorships from politics to economics. In these articles, they argue, it was a 5-year-old article, where they argue that authorities are handing down instructions to journalists not to talk bad about the economy. And then in the summer, when it became clear that the Chinese economy was doing not so good, we got this article from Financial Times saying that Chinese economists were told not to be negative as the rebound falters. So it was a pressure, allegedly, that economists should not speak about the economy in a bad manner, because that would kind of be a self-fulfilling prophecy. If everyone says the economy is doing bad, well, then inevitably it's going to do bad as well. Andreas mentioned inflation. Of course, that has been the big topic for over a year now. We've seen inflation rising to its highest levels in several decades. In the US, inflation rose to above 9% and peaked in summer last year, and has come down quite considerably back then. And going back to what Andreas mentioned, here the US economy also stands out, because the US has managed to bring inflation down while the real economy still holds up quite well. So talk about a success story here. And we see that actually inflation in the US is lower than in Japan right now. That does not happen very often. For China, the story is completely the opposite. Here, inflation has been very much subdued in the recent years. And now in the summer, we saw that China slipped into deflation, the opposite of inflation. And that's when prices are going down. Perhaps if you're a consumer, you like the prices going down. But from an economic standpoint, this is just a warning sign that shows that there's a lack of consumer demand and that the economy is slowing down as well. And by the way, this previous Financial Times article that I mentioned, it also said that deflation was one of the words that Chinese economists were not allowed to use. And since the economic outlook and development has been different in these two economies, the policy response has also been different. The Federal Reserve, the US Central Bank, raised its policy rate by over 5 percentage points since last year, to very high levels right now, to try to combat this soaring inflation. The Chinese Central Bank, the People's Bank of China, has did the opposite. They have eased monetary policy recently in an attempt to stem this economic bleeding, to stabilize its property sector that is in a downturn still. But this easing has been, the rate cuts have been minor. They've been few and far between, and have only had a marginal positive impact on stabilizing the economy. And we still think that the Chinese central bank will continue to do this kind of policy support for the economy. But I think that for as long as the economy is scarred by this pandemic and by this property sector downturn, this policy response will have only a limited impact on the economy. So unless confidence is restored in the overall economy, then it might take some time before the Chinese economy stabilizes. So it's not only monetary policy where China and the US are diverging right now. They are also diverging in terms of its trade view. China and the US are in the middle of a trade war right now. This all started when Donald Trump became president. He was very unhappy with how China did trade. He said that they were stealing US intellectual property. So he imposed a lot of tariffs on China to limit the trade deficit that was happening against China. And then Joe Biden became president, and some people perhaps thought that he would roll back on some of these tariffs. That has not been the case. Actually, Joe Biden has gone even further than Donald Trump and imposed even more export restrictions on China, on China's accessibility, for example, to different advanced technologies which are used for military purposes. China has responded tit for tat, also imposing their own trade sanctions towards the US, and during the summer, China imposed export restrictions on a few metals, which China is a top global supplier of, which is used in the production of semiconductors. Next year, there's going to be an election, presidential election in the US, and we have politicians on both sides of the US political spectra who are both becoming even more aggressive towards their communication against China. We have Joe Biden, who is running for a re-election. During the summer, he called Xi Jinping a dictator. China was not happy with that, said that that was a clear violation of diplomatic protocol. And then we have the two top Republican contenders, Donald Trump and Florida Governor Ron DeSantis. They also want to limit trade with China. And in China, there's this notion that the US is doing this because the US wants to curb China's rise as a global economic superpower. Andreas just now showed a graph showing trade, global trade, and that world trade with China has been going down as a share of GDP. So, of course, this trade war also affects the economy badly. It lowers US imports from China. Perhaps some foreign direct investment will be redirected away from China. But it could also lead to kind of this rewiring of global supply chains away from China towards other countries, in the US case, for example, in Vietnam or in Mexico. And this is also something that affects China's growth. It also affects the US growth also, and it could lead to higher costs. You know, if US rely less and less on cheap Chinese manufacturing to place their supply chains in countries like Mexico, then, of course, company costs will increase, so also consumer costs, which could add to inflation in the US. So China, perhaps you've heard of this China model. So China's growth model has been very investment-driven. Back 40 years ago, in the 1980s, China started to reform and started to reopening or opening up to the world. And back then, China was very underdeveloped. It needed to invest in a lot of stuff. It needed to invest in infrastructure, in education, services, in housing. And that's what China did back in the 80s, invested heavily into this kind of stuff. And that propelled China's growth greatly forward. But then in the middle of the 2000s, China had filled up quite a lot of what it needed to invest in. But that didn't stop China from continuing to invest. China continued to invest, especially after the global financial crisis. There was a huge stimulus where China invested considerable amounts in, for example, real estate, to prop up growth still. But these kind of extra investments beyond this point had diminishing marginal returns on the economy. So perhaps you've seen these ghost cities in China. That's huge buildings, sometimes apartment blocks, whole neighborhoods, even cities, with big buildings where no one is living in. But China invests in this because it produces growth. Another example is that many small cities have airports in China. There's no reason to have an airport in these small cities in China because China's railway system is very highly developed. It's very good, so you can just take the train in China. It's much better than flying domestically. But it doesn't matter if no one is living in these houses. It doesn't matter if no one is not using these airports. What matters is that they produced GDP when you construct them. But of course, if no one is using it, it's not really a good return on investment, of course. And what it also has done is to increase China's debt level considerably. So China's total debt as a percentage of GDP is 300%. So China's total debt is 3 times as high as its GDP right now. Basically, China's economy is very much out of balance, and investment still makes up a considerable amount of China's GDP. We see that here consumption makes up less than 40% of China's GDP. That is much lower than in the rest of the world, and certainly much lower in the US, where 65% of US GDP, that's consumption. And China has had this urge to rebalance its economy away from investments and towards consumption for the last 15 or so years. But it is very difficult for China, because it will mean that after 3 decades, when consumption has lagged GDP growth, it must now be the driving factor behind GDP growth. So just mathematically speaking, that would mean that GDP needs to grow higher than investments, and consumption needs to grow higher than GDP. And unless consumption really surges in China, which could happen, but I don't think it will, then it will mean that this rebalancing of the Chinese economy will hurt China's long-term growth. And we will probably look at GDP growth closer to 2% in the coming 10 years in China, compared to the double digits of growth China has had in the past decades. Another challenge that the Chinese economy will face is its demographic structure, its demographic shift. Here we see that China's birth rate has been falling quite a lot over several decades. So fewer and fewer babies are born every year. We see that, as you know, China implemented its one-child policy 40 years ago. Then back in 2016, they implemented a two-child policy, and now 2021, a three-child policy, meaning a family in China is now allowed to have 3 children. But as you can see, it has not helped China's birth rate. It has continued to go down. There's a couple of explanations why this is the case. For one, the social welfare system in China is quite poor still. It's also very costly to raise children in China, and parents, they work very long hours, so they don't have time really to take care of children. Perhaps also there's been a psychological shift in how a family should look after 40 years with one-child policy. Perhaps that could also explain this. But this will also affect the economy. We saw that last year China's population shrank. So China's population number was lower in 2021 compared to in 2021. And this reduction in the population happened way earlier than many had thought, and is a development that is expected to continue going forward. And actually, India now has a higher population than China because of this. A related topic is that China's population is getting much older as well. So China's population in working ages is shrinking as a share of its total population. And that's also something that will hurt the economy, because it will mean that China's economy will be increasingly more reliant on productivity growth in order to grow. And this will also have huge effects on China's welfare system, because it will mean that an ever-shrinking labor force will need to take care of an ever-expanding elderly force. So it will hurt, or it will affect pensions, it will affect healthcare, and tax incomes, tax revenues will also be lower. It could also affect the global economy as well, because when China's labor force is shrinking, it will mean that China's compensation for workers will also increase because of these labor shortages. So wages in China will probably rise as a result of this. So manufacturing stuff in China will be more costly. So this could add to global inflation as well in the very, very long term. For many years, many economists had made the prediction that one day China will overtake the US economy and be the number one, be the largest economy. And that's when China grew so rapidly 20, 30 years ago. But as we see, that still has not happened, and that day may never come. And in fact, if you look at it, it actually looks like they are diverging right now rather than contracting. And we talked about several cyclical and structural challenges that the US economy or that the Chinese economy will face right now, like its sluggish recovery from the pandemic, its property sector downturn. We have deglobalization. We have this rebalancing of the economy and its demographic shift. All of these, to me, suggest that growth will be slow now in the near term, but also that China's long-term growth potential will be lower, and that China's growth rate will be much lower in the next 10 years compared to what it was 10 years before. And as a result, it may never be the case that China catches up with the US, at least not in the next 20 or 30 years. And there's also a risk that China will have the same development as we've seen in Japan. Decades, we talk about these lost decades in Japan. The difference is that Japan has already become a developed country. China still is not a developed country. And because of this, it may never become a developed country. All right, thank you for listening.